All right, welcome everybody. Thanks for joining us today. My name is Clay Malcolm here at Advanta IRA, and today we're going to be talking about tax insights, tax tools, how they work, both inside your IRA and outside your IRA. And one of the reasons that this presentation got put together is because I get a lot of questions about taxes and investing inside your IRA versus outside, or very specific scenarios that somebody has going on. And of course, I'm not an attorney or a CPA, and so I can't give, and we don't give advice either, so we're a pretty neutral part of the equation. So I thought I would just turn to one of my friends, Scott Estill, who's an expert tax attorney and former prosecutor for the IRS. So he has a lot of insight into these types of things. And so I thought I would invite him to be on, and he was gracious enough to accept. So he's going to be on to give the bulk of the presentation and share his expertise when it comes to tax matters. I'm going to go ahead and start the presentation with a little bit about self-directed IRAs, and I too am going to focus on kind of the tax proposition and things that people think about typically, or maybe have thought about at the beginning, but then put it out of their minds. But the way that IRAs work and what some of the key elements are, and so that'll take probably 10 minutes or so, and then I'm going to turn it over to Scott, and he's going to take the bulk of the presentation time, and then we'll definitely have questions and answers. So we're going to do that at the end. So on your question box, please locate that on your console and go ahead and type in questions as they occur to you. If we don't cover it during the presentation, then we can address it after the fact. So we welcome questions. Happy to have that interaction with you, and hopefully this presentation and the Q&A will answer some questions that you had that would help inform your investing strategies. So with that, let's go ahead and get started. So you don't really need my picture because I'm here on video, but again, my name is Clay Malcolm, and I've been in the self-directed IRA and solo 401k investing space for 10 years. And I've also been doing, so I've been doing that professionally, but I've also been doing it as an investor. So I have self-directed IRAs, self-directed HSAs. I'm not self-employed, so I don't have a solo 401k, but I do handle a lot of clients who come to me, and we talk about how that can be a tax tool for them. So, and I'm always happy to talk to somebody about the particular investment strategy you're thinking of inside an IRA or another tax advantaged account, or to just give you the basics. So you can do that one-on-one. If you want to have loop your team in, that's fine too. But there's my contact information, and understand that I'm certainly a professional in the space, but I'm also one of you as a self-directed IRA investor. So I understand the activity that we all need to go through to get our tax advantage dollars put to work and that kind of thing. All the information that I'm going to give today is for education purposes only. At Advanta IRA, we do not give tax, legal, or investment advice. We don't advocate any particular investment strategy or investment vendor. And we certainly encourage you to bring along and engage your professional teams when you are doing the due diligence on any investment. So that could be a CPA, an attorney, financial planner, could be your family, whoever it is that is your team. We encourage you to consult with them as you do the due diligence, because in a self-directed IRA where you're going to invest in alternative assets, say you have an account at Advanta, the due diligence process is up to the account holder, right? So again, we don't give any tax, legal, or investment advice. Our job is really to do the bookkeeping so that the tax advantages of the account apply to the assets that you purchase within your account with us. So, alternatives, and we'll talk a little bit more about that obviously here in a moment. Whereas most disclaimers are a little bit of a throwaway, I do think that this indicates, our role in the process, again, documenting the activity, and your role as the motive force behind all of the investments that occur in your account. And at Advanta, we actually are built for customer service. Every account holder gets a 2-person team. Myself is kind of an education and onboarding person, and then also a back office account manager who's expert at the mechanics of the account, as well as investment paperwork and things like that. So you do have our phone numbers, you have our emails, so you know who your team is at Advanta, and you can get a hold of us at any point. And we were actually built that way by the owner. So Advanta is certainly, we're well versed in what goes on. We're a medium-sized company in the space, so about $1.8 billion of assets that we do the administration for. But long tenured employees, company invests in our ongoing education, and like I say, it's built for somebody to know who they're dealing with and to be able to get a hold of them throughout the process of their self-directed IRA investing. So I'm going to just set the stage about self-directed IRAs and IRAs in general, and then Scott's actually going to do some really interesting stuff where it comes to analyzing tax advantages inside an IRA versus outside. So the proposition that IRAs are for us, that is being offered to us, is basically this: the government's going to give us some tax advantages on a certain amount of money for basically any number of years, decades, etc. I mean, that's a little open-ended. They're going to give us some tax advantages on some money so that we can hopefully save for our retirement and do that with more effectiveness, right? So each time we make an earning, doesn't necessarily get chipped away by taxes, so we get to keep investing that money. So the compounding effect is really one of the main gets that we accrue when we do our investing in an IRA. And the rules or the proposition is basically this: the government says, hey, we'll give you these tax advantages, and you have to do two things. One is you have to have a custodian that's part of their tracking system for the money, and you have to follow some rules. So there are some rules about prohibited transactions. There's a couple of asset classes that are prohibited, and you can find out that information either by calling me or looking on our websites. That stuff's pretty easy to come by. The accounts are going to have contribution rules and distribution rules, but as long as you follow the rules and you have a custodian, then you're going to get the tax advantages that are associated with the account type. And when it comes to self-directed IRAs, really what we're talking about is the combination of the tax advantages of the account type and having that combined with the returns that you can have in quote-unquote alternative assets. And so the general categories of investment assets that we handle are real estate, private equity, private lending, cryptocurrency, precious metals, and those are really broad categories. But at the end of the day, almost anything that you know how to make money at outside your IRA, you can make money at inside your IRA. You just need to take the time to set it up properly. But all kinds of alternative investments, including these debt instruments, equity participation, owning physical real estate or physical gold or silver, platinum, palladium, owning cryptocurrency, all of those things are available to be combined with the tax advantages of a traditional IRA or a Roth or another account type. And do understand that you can have multiple IRAs operating simultaneously, traditional and Roth, but you can have several traditionals and several Roths. I'm in the business, so I think I got a little carried away. I think I have 6 or 7 IRAs and a couple of HSAs. So you can have them operating simultaneously. And often what you're doing is making sure that the IRAs are positioned at a custodian that handles the assets that you want to get into. The IRS does not say to IRA providers, hey, you have to handle every asset that's allowed by law. That's just not the way it works. The IRS doesn't make that mandate. So IRA providers choose which assets they will let their IRA customers invest in. And at Advanta, we've chosen a very wide array. There are very few assets that we don't custody. And if we don't already have do custody for the type of asset you're thinking of, we'll certainly look into it for you and see if we can accomplish that. It's not always feasible, but most of the time it is. So we're happy to look at almost any type of investment that you are thinking of. And to be clear, the account types, because self-directed is really just a descriptive term, it's not an account type. The account types are the ones that you know of: a traditional IRA, Roth IRA, health savings account I mentioned. A lot of people don't know that that's an individual custodial account, operates a lot like an IRA, has tremendous tax advantages. So please do, if you have a high deductible health plan and you qualify for an HSA, please do look into it because it's such a remarkable tax tool. We also handle SEP IRAs and simple IRAs, as well as solo 401ks, and we even do Coverdell education savings accounts. So all of these account types with their contribution rules, distribution rules, and tax advantages are available to invest in all kinds of alternative assets. And as I mentioned before, you get to use the network that you have already. We don't actually supplant anybody. We're more of an add-on. So when you want to have your tax advantage money or some of it, invested in an alternative, then usually you'd open up an account with us, do a transfer or a rollover, and start into that alternative investment strategy. But you get to bring your real estate team, your tax team, your legal team. Everybody gets to come with you. We're really just there to make sure that the account activity is documented so it gets to stay in good standing. And remember that the IRS mindset is basically this: they're going to give us these tax advantages, but there's a tax event that's associated with it. And so they are going to track that money. And that's why they, first of all, require custodians, because we're part of the tracking process. We're there to document all activity, money in, out, invested, et cetera, et cetera. And IRAs are a legal and financial entity, so they will be separate from you personally. IRAs have a separate name than you personally, separate bank accounts, different tax ID number, because they have different tax status. And so keep in mind that when you are operating your self-directed IRA, it's you as the decision maker for sure, but it does operate slightly separate from your personal finances. So that's really the way that the IRS is able to track the money and to be able to give the tax advantages to this certain amount that they've allowed for us. And I put this up there on there just to kind of reiterate that you can't have multiple accounts, but you also can move tax advantage money from one account to another in a lot of cases. And the reason that you would do that, again, is to get your money positioned at a custodian or an IRA provider that handles alternative assets. So you can see that this is really about moving money from one account to another, and there are a lot of yeses up there. So looking into taking an inventory of what tax advantaged accounts you already have and where you want them positioned and what you want them to be invested in is a great exercise. And so I always encourage people to do that and think about whether they can be combined, or you might want to separate them. But your options, it's not as static as most people think. You often have the ability to kind of position the money where you think it will work best. And it's actually a very easy thing to do. So some people will think that this takes several months to put a self-directed IRA together and things like that. It's not the case. So we open an account once we have a completed application in a business day. Transfers and rollovers, transfers usually from another IRA or a rollover from an old 401k. That can take as little as a couple days, and sometimes it does take a few weeks. So understand that there is some time latitude there. But all that time you can be looking for investments, and then once you decide on the investment, we can deploy your IRA money to close that deal quickly. So if you have a day, or a day is a tough one, but a couple of days where we have the completed investment paperwork, we can deploy that money as you direct us to, which is something that is part of your responsibility to as the account owner. Do understand that there's a lot of resources that we'd like to provide for our folks. So events like this one, there's a video library of all of our webinar and education materials, and also our blog keeps you up to date on current events such as the IRA legislation that's pending, things like that. So please do check out our website. And we do also do an investor networking event for investors to come and talk about the investments that they're looking for. And also, some investment providers come and they say, hey, these are the things that we're into, and if you're interested, you can contact us. So we do it every other Friday. The next one is this Friday, October the 22nd. So for those of you who are listening to this live, if you want to tune in, it's called Pitch, Promote, and Prosper. Please do check that out. And if you're listening to the recording here, just look on our website for the next iteration. It's like I say, every other Friday. And at this point, I'm going to go ahead and turn the presentation over to Scott Estill, tax attorney and longtime person that I ask questions to. And let's see if Scott, did I get the screen over to you?
You did, yes. You did, Clay.
Yeah.
So am I on the right screen this time?
Right screen's perfect. So for those of you in the audience, I'd like to introduce Scott Estill. He's going to talk a little bit more about his background, but is a tax attorney, and like I say, he's a person who is has a great amount of expertise and insight into the way that these accounts work and just taxes work in your general kind of personal financial world. So Scott, thanks again for being here, and I'm going to let you take it away.
All right. Thank you very much, Clay. Really appreciate being able to spend, I don't know, another 30 minutes to 45 minutes on just some of the tax considerations that I've seen over the years with IRA accounts, 401ks, SEPs, doesn't really matter when they're self-directed. And I think, you know, your point initially that any of these accounts really can be self-directed is important because a lot of folks aren't aware of, you know, I think what they can do and what they can't do as far as their retirement assets and their investments go. You see my mugshot up there. I'm a former, with the keyword former, senior trial attorney for the IRS. And so I'm a Chicago boy originally. I'm living in Denver right now, so I'm speaking to you from Colorado. But since I left the IRS back in '94, so it's been a long time, but I've really devoted my professional career to education and how can I get the word out that small business owners, investors, real estate investors, stock market traders, whatever you happen to be, there are tax plans out there, and that tax planning is not just for Bill Gates, right, or Warren Buffett or LeBron James or somebody that's worth hundreds of millions or billions of dollars. It's for all of us. And you know, if we can save a few dollars here and there on taxes, that's real money that we can use for our family, right, or for doing whatever it is that we want to do. So again, I want to thank Clay for having me on here, because I think this is a really valuable service to, you know, any of the clients of Advanta, or you know, anybody that has an IRA for that matter, that we need to make sure that, you know, not only do you understand why you're doing it, you know, what's the benefits of doing it from a retirement planning perspective, but what are some of the tax advantages that we can pull out of this while we're doing it. So before I get into the presentation, as most lawyers, I've got to have disclosures and all of these warnings and everything else, but just so that I can make sure that we're all on the same page here, any of the information I'm giving is supposed to be or intended to be general in nature, and it's not specific advice. And the reason for that is because everybody that's watching this presentation, you know, whether it's live or whether you're watching the recording on this, everybody's situation is unique. And so therefore, I don't know what investments you have or should have. I don't know your age. I don't know how much money you have. And I don't know what your investment goals are. And so there's a lot of things that come into play, but just make sure that you do your due diligence on any investment that you're considering, you know, whether it's buying a piece of real estate or whether it's going in and buying a mutual fund or, you know, Apple stock. I mean, you've got to do your own due diligence and work with your professionals, whether it's somebody like Clay on the IRA side or whether it's your tax professional, somebody to help you with the tax planning. So let's move in now to the solo 401k plans and the self-directed IRAs. Now they're really in general the same animal. I mean, there's a slight differences in the way that they're taxed, some slight differences in what you can and can't do, but for the most part, these work the same way. And you know, like Clay was mentioning, basically what we're taking is, in this case, in this slide here, a solo 401k plan, and we can put that into any investment pretty much that we want. I mean, there's a few that are prohibited, but we can put a lot of money in, and it permits a lot more of a contribution amount than an IRA. So you can see we can put in this $19,500, and that's really just the baseline. That's what the employee can contribute. But we can also then get into, let me head back here for some reason that just advanced on his own, but with the 401ks, the contribution is tax deductible unless you do a Roth plan. And then all of the earnings that you can make inside of the 401k plan are tax deferred. And at the very end of it, when you start pulling money out, it will be taxable on a 401k plan unless it's a Roth. And so the question with a Roth is, do you want the tax deduction up front, or do you want to pay the, you know, get the tax benefits on the back end? And that's a question, again, that, you know, I have both. I have Roth plans, I have traditional plans. I have self-directed plans, and I have other ones that I'm just trading stocks in TD Ameritrade. So you can have multiple plans, multiple accounts, 401ks, SEPs. You can have a lot of different plans at the same time. You just may not be able to contribute to each of them every year. Now you can see the IRAs, that's got our small amount. If you're age 50 by the end of the year, you can throw in an extra $1,000. But for a lot of the investments, we're going to need more than the $6,000 or $7,000 amount. So in those situations, we typically want to be able to do rollovers. And so we can put something more in as far as the rollovers go. Before I get to this slide, though, a couple points on the rollovers, because I know Clay mentioned that a few minutes ago, in that I like to see anytime there's a rollover that it's done custodian to custodian. So what I needed, let's say I needed $50,000 in a self-directed IRA to do some real estate deal or make a loan or whatever my investment is going to be. I need to be able to get that money in, and at a $6,000 or $7,000 contribution rate, it's going to take me a long time to get it in. So I roll the money over, but I took the rollover directly from my IRA custodian to the self-direct custodian. I never touched that money. And that's real key, because if you do touch the money, you have a 60-day period to roll it over. And if you don't roll it over, it's going to be taxable to you. So let's not get into a timing situation or things getting lost or you forget or you get sick, something happens. Let's go ahead and do the custodian to custodian. Now I'm going to back up 2 slides here. When I showed the employee can contribute 19,500 this year, that's the maximum for the employee. Now I'll go 2 slides forward. You can see that, first of all, that if you're age 50 or more, that 19.5 can go up to 26,000. So we get a $6,500 bump up. But with the employer contributions, we can go up to $58,000 if we're under 50 years old, and then up to that 64.5 if we're age 50 or older. So we can put a whole lot more money into a 401k or a SEP plan than we can in a traditional IRA. Understand too that we can do a Roth plan, and for somebody that's quite young, the Roth 401k or the Roth IRA, really, really valuable as far as that goes. You take somebody that's 25 years old, let's say they're going to have the money in there for 40 years before they pull it out. Let's forget the $5,000 or $10,000 or $20,000 contribution up front, but think about what you could turn that 20K into over 40 years, and to have that money never taxed when you pull it out at age 65. So I think that's one of the really cool things about the retirement plans. And for all the time that I've been doing consulting for small businesses, I think that this is the #1 mistake that a small business owner makes, is that they fail to understand the impact that contributing to a retirement plan can have on like your overall finances, your overall financial picture. And I go back to when I was 25. I mean, the last thing I was thinking of is, well, I got to put money away to be able to save till I'm retired. I'm barely starting to work. I'm not thinking about retirement. So anytime I can plant the seeds in any business owner's mind, but certainly a young business owner, I'm going to do that, because not only can we grab the tax deduction if we want, and again, this is a choice that we have between a traditional and a Roth, but we get this tax deferral at a very minimum, where all the years that you're making these investments and you're doing whatever it is you're doing in your self-directed IRA, you're not being taxed on that. And that is a huge advantage over somebody that is being taxed on. And I think, if you go to, you call up Fidelity or you call up Vanguard or TD or somebody and you say, well, I want to invest in some real estate. And, they're going to say, well, you can't do that. And what they're really saying, or what they're really implying, is You can't do that with us, but you can do that with, somebody like Advanta that can do the custodial aspects of the self-directed component so that you can invest in all of these different things. And I'll give you some examples of the tax benefits in the IRA versus outside of the IRA on some of these different, real estate, or doing real estate investment trusts, or doing platinum, private lending, where you can maybe get, an unsecured 10% return on your investment, as opposed to, a 0.0001% on your money market. So there's lots of ways that we can invest in different types of assets that will allow us to have diversity. And so that's really the reason I do it. That, what happens if you put your entire 401k in the stock market, and the stock market keeps going up, and you see that 401k balance keep going up, and that's all well and good until it goes down, right? And we have a 10 or 20% hit to the stock market. And now all of a sudden, we've got a 6-figure loss potentially or more in our retirement account. But what if, instead of having all my money in the stocks or bonds or whatever, that maybe I put 50% in that, or some other allocation, and I can throw money into commodities, or into private businesses, or into crypto, or into other assets that maybe aren't directly tied to the stock market. And so if the stock market goes down, these assets may either stay the same, or they may go up as far as a hedging strategy goes. So again, lots of different investments and lots of benefits. I mentioned the diversification, but I like the fact that there's a huge amount of investment options. And yeah, we can defer or eliminate any of the taxes on the investment income, but we don't have to self-direct to do that, right? That's true for any 401k or IRA. But if we want the opportunity to be able to put put investment dollars to work in other investments, this is the way we have to go. Now, with any tax benefit or to any tax advantage, there's going to be some downsides, and that's just the way it is. And there are downsides with using a self-directed account that you typically don't have if you're going to let's say, trade stocks. When I go to my TD Ameritrade account and I want to, sell or buy an option, let's say on Apple, I'll use that one since I threw that out before. I can do that. I don't need to go to a self-directed. I can just go online, execute the option and whatever, and I don't have to worry about prohibited transactions or self-dealing. And those are the things that we need to be watching out for. And I've done entire webinars on the self-dealing issues. And so when we have, if you're getting a present day benefit to the investment, you're using a rental property that you have in your IRA, you can get into prohibited transactions. And that's something that, while it's not overly complex as to who's a related party, what is self-dealing, what can you do and what can't you do, you need to be aware of prohibited transactions. And the other thing you need to be aware of is that if you're running a business within the 401k or the IRA, that you can have to pay tax, this UBIT tax, this unrelated business taxable income. So I've seen it the UBTI or UBIT, either way, same thing. So don't think that you can do anything you want in a self-directed account, because you can't. You may have self-dealing or prohibited transaction issues, and you may be taxed on some of the income if you're running a business. So there are some limitations here, but I want to shift now for the next 10 or 15 minutes before we get into some of the Q&A to look at some of the examples here of some of the differences between what happened with some of the clients that I've seen in the past and what their tax hit would be if they would do a particular transaction in a taxable account. So here's a client. Now, obviously, we're going back quite a ways, back to 2005 here. This person buys platinum, and I don't invest in platinum, so I don't really know the volatility issues here, or what kind of price range we're at. So I'm a total newbie on this one. I would have liked to have made this investment, but I've never bought or sold platinum. But anyways, this person buys some platinum, 350 ounces, and holds it for about 6 years. Goes ahead and sells it and has a double on his hands here, right? He buys it for 300, sells it for 630, 634, whatever. And we've got a $332,000 profit. This person does this trade in a taxable account. This would be the tax hit here. Now, a couple of things that I want you to consider here. First thing is, oops, let me go back. For some reason, this is advancing automatically, my slides, so I apologize for that, but we'll just play around with it. But anyways, in this case here, we've got this $332,000 profit that, let's say this has been done in an LLC in his name, or this was done in a non-IRA, non-tax deferred account. We're looking at paying a third of this profit to the government. The 28% to the IRS is set up here as a collectible, and I've put in a 5% state tax rate. Now, for those of us that happen to be in Colorado, that number's 4.63, I think it is. They can go as high as, I think California's at 13. You could be in Nevada and have a 0% rate, being one of the other 6 or 7 states that has no tax. So this 33% is hypothetical. Yours could be higher or lower. But look at this, in this situation here, where we're giving away over $100,000 to the government. And, I don't know about you, but I've worked for the government, and I don't like the way the government spends money. And I worked for the state of Illinois as a law clerk right out of law school, and worked as a senior trial attorney for the IRS. So I've worked for a state government, and I've worked for the feds. And to see the way that they spend money and everything else, I want this $109,000 in your pocket. I want you to be able to do what you want to do with it and not the government. But it's your choice here, right? We can go back and you can buy this platinum in your self-directed IRA. There's nothing wrong with doing that. Or you can do it in your taxable account. And when you write this check to the IRS for 109 grand, IRS is going to cash it. There's no doubt about that. So let's make sure that you really want to write a check to the IRS for $100,000, or do you want to keep your total gross profit? So that's a platinum example. Let's look at some real estate. Yeah,
Scott, before you go on, can I ask a question that popped up in the box?
Yeah, absolutely. I want to erase this. Look at my scribbles here. There we go.
So the question was about the 28% tax rate. This person says, isn't that long-term capital gains at 15%?
Yeah, and that's that's a really, really good question, because first of all, when you get into collectibles, then you get into a 28% tax rate. So that's where this tax rate is coming from here. But the other problem, and this is even a more fundamental problem, is, you ask me, and I'm a tax attorney with whatever, a lot of experience, a lot of years, gray hair, whatever, right? What's the capital gains tax rate? And I'm going to tell you that I don't know it. And that's embarrassing, because under today's law, your long-term capital gains rate is 0%, it's 15%, it's 20%, or it's 23.8%, depending on who you are. And so that ends up getting us into a situation with, what's the tax rate going to be? But that's why I use 28%, if that makes sense.
Because it's a collectible is what you're saying.
Yeah. Okay.
Awesome. Thank you.
All right. So let's see. Let me look at example 2 here. Sorry, I don't know how I got these scribbles on, but anyways, this was another client. I'm trying to use 4 or 5 examples of people that I've worked with, and so I had some pretty good knowledge of what the deal was. But here's an 8-year holding period. So notice here that the first one and the second one, we're not talking about flipping anything. We're talking about long-term transactions, and that's not to say that you can't flip or do short-term transactions in your IRA. If you're flipping real estate, though, understand that may be a business, and you may have UBITs. But be flipping real estate, in an IRA or understand the tax consequences of it. But I certainly use my IRA for short-term option trading because that's going to be taxed as ordinary income if I did it under my name. So you definitely want to look at what sorts of investments are in your IRA and look at how they would be taxed outside of the IRA. And if you can get a favorable tax rate outside of the IRA, then we may want to go that direction. But let's look at this this dude here. So this dude buys 100 acres of undeveloped real estate, pays a real small amount, right? This $475 an acre. And guess what? 8 years later, what happened to the real estate? Well, now the real estate came into play with somebody that was doing a lot of subdivisions. And it turns out that this property was located near where they were building a highway exit. So our $400 an acre now goes up to over $8,000 an acre, and our relatively small investment now turns into a huge profit. And so now let's go back to Clay's question, what's the capital gains rate here? Well, this person having a capital gain, or at least proceeds here, of the 850 and the capital gain of the little bit over 800 is going to be in the highest tax bracket, which puts them at a 20% capital gain plus the 3.8% Obamacare surtax or surcharge. And so that's where that 23.8% came in. And so there we're going to get into the 28.8% rate, again, assuming that you have a state tax rate. If you don't, then this 40K would go away, right? So we could just cross that out. You live in California, live in New York City, or some other high tax locale, this 40K could be considerably higher. But again, huge chunk of your overall profit is going to go to Uncle Sam. And again, I mean, I cry when I have to write out a $2,000 check to the IRS, a $200,000 check. I mean, I don't know, that could like throw us into a serious depression, right? I mean, I don't want to write that check, and I don't have to if I was smart like this guy and bought my land inside the IRA, right? And again, this is looking at taxes. This person could have made this same exact deal in a taxable account, right? Just go out, wherever this was at, whatever. Let's say it's in Colorado. I can set up a Colorado LLC within an hour. I can have, assuming the IRS is working its website, I can have a tax ID number. I can have my LLC set up in Colorado, and I can go down and open up a bank account and make this deal in a taxable account. It doesn't take a whole lot, but by doing it in the taxable account, again, I'm going to write a $231,000 check in this example. All right, example 3. So this is a private money loan. Again, this can be done in a taxable account or in an IRA. But this was a private money loan. It just came due last year. But anyways, so we got a 3-year holding period, and this was a balloon payment. So what happens here? Well, this client loans $250,000, and the person that receives the loan pays nothing for 3 years, and then the balloon comes due. So after 3 years, this $250,000 comes due. Okay, and so now we get a $353,000 payoff, and we've got a $100,000 profit. Okay, not bad on the amount loaned here. When you're looking at 12.2%, so now we're at what, over 3 years, 36%, and now we're compounding it. We've got a lot of taxes due, right? This 34,000. Now, again, I'll go back to Clay's question. Where did this 28% come from? This would be considered ordinary income. This profit right here that we're dealing with is interest income. So that's going to be a tax bracket gain. So this 28%, this could be something between 10% all the way up to 37%. And if the Democrats figure out exactly what they want to do now with the spending and the taxation, that 37% could be 39.6. And I think that's what we're going to see. So this 28 grand in theory could be considerably higher. But anyways, again, do you want to, have a gross profit of 69, or do you want to have a gross profit of 103 as far as the taxation goes? And so I don't like the net profit because, again, this 34K check to the IRS, I don't care for, and I can avoid that. And not that this has anything necessarily to do with IRAs, but one of the speaking topics when I give more general presentations is that the average taxpayer doesn't understand that they have so many choices with taxes. They think that if I want to do this deal, these are the tax consequences. And what I like to look at is, what deal do you want to do? What is it that you want to accomplish here? So if I go to this person here and say, well, what do you want to accomplish? What are they going to say? Well, I want to get my 250 back plus my interest in 3 years. And I was like, okay, so if we do that in a taxable account and we do some math, you're going to owe 100 grand in tax. Is that okay? And if the answer is yes, or excuse me, you're going to have 100,000 in profit, you're going to owe 34,000 in tax. And if the answer to that is yes, I'm good with writing the 34K check, then fine. We'll set this up in an LLC. We'll do it in a taxable account, and all's well and good. But when the thought of saying, well, I'm going to give a third of my money to the government, how can I avoid that? Right? Not evade it, because that's illegal, but avoid it is legal. And this is the way. Okay, example 4. Another one here. 26-year-old. Okay, this was probably one of my favorite ones that I've ever seen. And obviously, I'm giving you some good examples here. I'm not giving you somebody that invests 30,000 and gets back 31,000, or loses money and you don't get a tax benefit then. But here we've got a 26-year-old deferred the maximum amount, okay, the 18K that she could do, and then the employer contributed another 18K, so the employer matched it. So we've got a $36,000 investment in a 26-year-old, so we can take some risk, and gets a friend's startup business and gets a 15% interest. The friend here is not considered to be a related party, so we don't have a prohibited transaction. But look what happens here. In that this 15% interest that was worth 36 grand now gets, when the business gets sold for about 8 million, she receives this 1.17 million. And now we've got this major profit. And we can say again, we've got an investment in a business. So we've got a capital gain. So again, that's where our 23.8 is. Highest bracket is 20 plus the 3.8% surtax. And here we've got an investment in a business. Okay. And so look here that again, we're giving up, not quite a third, but a huge chunk. And can you imagine that? This one was, I advised her here, well, if you can do it in a tax deferred or a tax-free account, let's do it. And she was all over it. Okay. I'm sure she would have liked to have had this $1 million, but when we tell her, well, look, yeah, you would have liked to have had the $1 million, but actually you're only going to get 800,000, which is a huge amount of money, right, for this person. But it could be huger, if that's a word, because we wouldn't have to write out this massive check. And again, $328,000. I mean, that's money that we don't have to write this check. This full $1 million, 1.134 million, stays in the account and now can be invested in other things. And with her track, and I don't know what she did with the money, by the way, but with her track record, man, I'd be investing in several startups. I mean, that would be amazing. But she can take this money and do whatever she wants. And over the next 40 years, what is this number going to grow to? Hopefully, it's going to be a lot more than 1,134,000. Maybe it'll be 10 million. Maybe it'll be 100 million. I don't know. But any number over this 1 million is going to be tax deferred, right? Any of the earnings. All right. And here's my last example. In this example 5, this person invests 50K for a 5% interest in his brother's LLC. And the reason I put this one up here, and this one is a still current investment, as you can see here, I put this up here for two reasons. One, because I put the brother up here. And the first thought that I would have is, I can't do that because that's a related party transaction. And when you look at the related parties, it turns out that the brother is not a related party. So if I would have done this to my mother or my child, it would have been, and this would have been no good. Okay, I couldn't do the investment. But because it's my brother, it's a non-related party. It's not a prohibited transaction, and so makes this investment. Now, in the next year, turns out January of this year, we get our tax documents, and this LLC kicks out a K-1 to all the investors in there. And so this would be if you have a taxable account or not. For instance, I have a law practice where I do some consulting, and in the law practice, it's an S corp. And so at the end of the year, excuse me, I guess at the beginning of the year, in January of 2021, I got a K-1 from my law firm that showed I got to report this amount of income, line 1, on my personal return. And so this investor gets the same thing, except that the K-1 is titled to the IRA, not to the taxpayer, to my client here. And so he gets this $22,000, which is taxable income. And again, I use using this 28% number because of the brackets. This could be 10%, this could be 37%, or anything in the middle. But in this case here, he's got a $7,500 tax bill if this was done outside of his taxable account, right? Oh, excuse me, outside of his IRA. So the question here is, you know, of this 22 grand, do you want 22 grand or do you want 15 grand? Because that's really the investment. Now, of course, if he wants to live on this 22 grand, if I go back to the scribbles here, but let's say he's investing this for income to live, then obviously I don't want this into his IRA. I don't want to have to take distributions out. I'll just put this into, you know, my name or whatever, and I'll just take the 22 grand out. But if I don't want to pay the tax, I don't need the money, well, then we're in a pretty good situation. So again, it's your choice here as far as how we go with things. And, you know, and I'm going to leave this slide up here because I think this is an appropriate quote here for my presentation. But before I get to the Q&A and I bring Clay back, we did have a question before we began, and it was an interesting question that I want to answer right now. And that had to do with a gentleman that asked the question, has a big gain in a crypto. And is that going to be taxable if he sells it? And the answer, of course, is yes. Unfortunately, he didn't do this transaction in his IRA. So he's got a taxable event. And I think the really good thing about, you know, somebody that's asking this question is that he's considering a lot of different possibilities here. So if we're not doing this in an IRA where we get this tax benefits of either a tax deferral or if you do a Roth, it's tax free. But we're doing it in a taxed account, I guess, for the lack of a better way to put it. We're going to pay taxes. What can we do? And he was asking about, can I put that into an opportunity zone, an opportunity fund zone, or whatever? And the answer is yes. So if we can't use a self-directed IRA and we can't get ourselves into a 0% capital gains rate, you know, maybe through gifting or something else, and we don't have losses, so, you know, we don't have a big $100,000 capital loss to offset some of the capital gains, and we want the money. In other words, we don't want to donate it to charity where we could get a tax benefit there. You can throw it into a qualified opportunity fund. And this can be directly, or you can do it directly into a property. The downside with it is that you've got to hold the investment long term. So you may not, you know, you invest, let's say you make $1 million in a crypto trade, and you're going to pay tax on that $1 million. You can invest that into a qualified opportunity zone fund or property, and not have to pay the tax on that $1 million today. And in fact, if you hold it for a certain period of time, you can eliminate 15% of the tax, and you can eliminate all the taxes on the investment earnings when you put the $1 million in there. So there's lots of pros and cons there, but I really like the question, because here's the question of, hey, if I did this in an IRA, it's a no-brainer. You know, I don't get taxed on it till I pull it out, and that's my worst case scenario. But now it's like, hey, I got this great trade. I'm really happy. I'm making the money, but how can I avoid either some or all of the taxes? So I'd like to thank Larry for bringing that question to my attention, because I'm going to throw that into my next presentation. I think I liked it. So anyways, Clay, do we have any additional questions here, or was my presentation so clear that nobody has any confusion at all?
Well, as it turns out, as clear as it is and was, there are some questions. So, and let me start with this, because it does, I'm going to kind of paraphrase a couple of things that popped up in the question box that also have to do with what you just mentioned. So in the world of these investments outside of an IRA, it sounds like one option in some cases would be to be able to shelter some of the capital gains in an opportunity zone fund. And so are there other techniques like that for investments that are not in an IRA that could mitigate the taxes, or any thoughts on that?
I mean, that's always the tough question here, because the opportunity zones are new. They were put out with the Trump tax cuts, and they came into effect in 18. So, and the purpose of them was to encourage investments in distressed areas. And I think there's like 7,500 or something in the United States. So it's not hard to find an investment, but that's really our best opportunity, no pun intended, to be able to avoid the capital gains in a taxable account. If you're dealing with other things like real estate, you can do 1031 exchanges to defer out, and with estate planning, possibly avoid all the taxes. So there are a few other things that you can do, but you know, if you're going to do investments and you want to avoid taxes, I mean, the IRA, 401k, I mean, that's really that's the game in town.
Well, and I'll just chime in on my part of this, and in terms of the questions that I get asked and things like that, and please do elaborate on anything that you feel like I'm missing here. But you know, and in fact, I'm going to morph this into a quick. All right. Well, I'm having a fire alarm here in the building, my office building. Okay. All right. Well, let me do this. Let me say this question and kind of let you go, and I'm going to go see if I can find out what's going on here. So, lots of people will ask me, should I make an investment inside an IRA or outside of an IRA, especially when it comes to real estate, because real estate does have some tax advantages or tax techniques that you can use with your personal money. So when you hear somebody ask about that, should I invest inside an IRA or outside, what are the criteria that you use for your clients and things like that, Scott?
Yeah, and that's a good question, because I think real estate's probably the best place that we can look at from a sense of there are tax advantages outside of the IRA that we need to consider. I have real estate inside and outside of my IRA, and I think the consideration here is, you know, what's your time horizon on the property, how long do you want to hold it, and what's your end goal in the property. And I'll give you an example of why I have a property inside my IRA and one I have outside of my IRA. The first one inside of my IRA is a cash deal. And so this property was one that I didn't finance, because if I finance properties inside my IRA, I may have a debt issue that's going to cause some tax issues inside of the IRA when I use leverage inside of the IRA. So this property, we'll just say it's 100 grand. So it's a $100,000 rental property, single family residence. I go out and I pay cash for it with my IRA. Now all the rental income, everything goes into the IRA. And when I sell it, any gain that I have goes inside the IRA. Now, why did I do that deal inside of my IRA? The reason I did it is because I did a cash deal here. And with the cash deal, I'm now able to, I'm going to be showing a profit in it because I don't have an interest deduction for the mortgage. And so therefore, that deal is going to produce cash flow, which hopefully all of my rental properties will, but that deal will produce cash flow and it will be taxable because I don't have enough deductions to offset it. Now, let's take one outside of my IRA where it's fully leveraged, right? I mean, I had to put down, I think it was 15, it may have been 20%, but whatever, let's say it was 20%. So I buy a $100,000 property, put 20K down and finance the 80,000. Now, even though that property is cash flowing positive, I am getting a tax benefit because not only am I deducting the depreciation, which is a sort of a non-cash expense, but I'm also getting to deduct the interest, which gives me a tax loss. And that tax loss then can be used either to offset other ordinary income or other passive income, other investment type income. So I think you want to look at what are you trying to accomplish here? And I would run the deal, I would run the numbers both inside and outside of an IRA just to get a ballpark. You know, so I'm going to buy a place for 200. I'm going to get $2,000 a month in rent. I've got these expenses. I'm going to cash flow $500 a month. What if I did that in a taxable account? And then we look at the depreciation. We look at all of the deductions, and we can say, well, that $500 a month is going to be $100 a month. So do you want to pay tax on $1,200, or do you want to do that in a tax-free or tax-deferred account? And that's really, I think, what the question becomes.
All right, well, I'm still under the fire alarm, so I probably need to vacate the building. Hey, Scott, I pasted a couple of the questions from the Q&A box into the chat. Can you see those and retrieve those?
Yes, let's see. I do have those. Why don't you go ahead and take care of your fire alarm, and I will go ahead and answer these questions and end the presentation. So.
Okay, thanks a lot, Scott. Thanks, everybody. I apologize for this. I gotta vacate the building, I guess. So we'll see you later.
No worries, Clay. See ya. All right. So let me get to there's a couple questions that Clay, okay. Clay sent over to me. First one is, if we flip a property in an IRA within a year, how are we taxed? Well, that is a good question, because when you look at flipping a property, the first thing you have to look at is, what was your intention when you bought the property? Okay, so what do I mean by this? Well, let's say that I bought a property in my IRA, okay, and I'm going to rent it out. And so I buy it today, I do some renovations, and you know, let's say it's a really quick deal. Tomorrow I put the sign up, you know, for rent, $2,500 a month. And somebody comes by and says, okay, Scott, I want to buy that property. I was like, wait a second, I just bought this property. I've got it for rent for $2,500. It's not for sale. And he says to me, you don't know what I'm going to offer you. I'm like, okay, what is it? I bought this property yesterday for 200 and he offers me 400. Some bizarre number, right? And so I sell it. Did I flip that property? Well, yeah, let's say I held it for 30 days, but my tax event there inside of my IRA would be zero, because it would be in effect a short-term capital gain, just like it would be a short-term capital gain and taxed at my tax bracket outside of my IRA. Now, the bigger issue here, and that's a question where I didn't intend to flip it. What happens if I do decide to flip it? You know, when I buy it for 200, I put 225 in, so I got 225 in, and I'm going to flip it for 300. That $75,000 inside of my IRA will be taxed under UBIT, and you will pay tax on that. And what you need to do if you're going to flip inside and outside of the IRA, so that's your intention, right? I have clients that specifically intend to flip, and that's what they do, and they may flip a property every month. And so when you buy a property today, you renovate it tomorrow and you put it on the market the next day, Obviously, we've got some time constraints in there, but when you do all of that, how are you going to argue to the IRS that you didn't intend to flip it, right? When all the evidence says you did. But when you go into a situation where you're trying to rent it and that's your strategy, and you end up flipping it because of a, too good to be true type of offer, that's where we look at the intent. So if you can, but again, if you're flipping inside of the IRA and that's your intent, we better understand the UBIT consequences, because in a lot of situations, the UBIT tax will be higher than the personal tax, and you'd rather flip outside. Or what I recommend, if you're going to flip, it sounds like a weird way to put it. If you're going to flip, do this. If you're going to flip real estate, what I recommend doing outside of your IRA is to do it in an LLC taxed as a C Corp, or do it as a C Corp, because you can get into a 21% flat tax rate, especially if you're going to churn the account and keep flipping. And you're not going to take the money out necessarily to live on. So anyways, that is a really good question. I appreciate that one. Can you have a solo 401k if you are a W-2 employee but have a side business used for real estate investments, etc.? And like most tax questions, that's a maybe. So you're a W-2 employee, so whoever you're, whatever you have through your employer, you can have. So, if you have a 401k there, you can contribute to it or whatever, and you can still do an IRA. Okay, because you have this what's called earned income, or income subject to employment taxes. So if we want to now have a real estate investment business, we're typically not generating any earned income. What I mean by earned income, again, not only W-2 that's subject to employment taxes, but if you have a Schedule C, so that's a sole proprietorship business, and you generate a profit there, your Schedule C gets hit with self-employment tax. And on that Schedule C, you can then use that for an additional 401k contribution. But typically a real estate investment, like, for me, let's say I've got a half a dozen rental properties, I cannot do a 401k off of that income, because that's all passive income, okay, not ordinary earned income. Good question though, because you can have multiple ones. Let's say that I have a job, I've got a 40-hour-a-week job, and I get a W-2. I've also got an independent business on the side. I do whatever. I do tax consulting for 2 hours a week and make a few $100 a week at that. I could then use that couple $100 a week of my consulting business, because I'm going to pay self-employment taxes on that. I could use that then to fund a 401k. And when I'm self-employed like that, I'm both the employee and the employer. And so I can do that double contribution. As long as I don't go over the maximum amount, that 58 grand that I had at the beginning here, I'm good to go, or whatever my maximum contribution is if my salary is a lot less than. So, all right, and we've got, quickly, why wasn't some of your investments taxed as a long-term investment? That's a question. I'm not sure what it relates to here on my screen, other than any of the investments that go for 1 year and 1 day or more are long-term capital gains. And that's where we can get into something between a 0 and a 23.8% rate. What we may be looking at is some of the collectibles. So you can hold collectibles for a long-term period, and that would generate a capital gain of 28%. So it's not that 0, 15, 20, or 23.8. So I think that's what the question was getting into there, but that's the way I'm going to interpret it. Okay, next one. Is it okay to do a leveraged investment, such as purchasing a property, put down 20% and borrow the rest, hold for 10 years and then sell? What potential tax implications? Any part of this transaction not allowed in a self-directed IRA? All right, so can you do that in a self-directed IRA? Answer, yes. Can you put down 20% and borrow the 80%? Yes. Can you hold it for 10 years and sell it? Yes. As long as you didn't buy it or sell it or borrow from a related party, you're okay here. So if you're going to buy this property from your mom, or you're going to borrow from your dad, or you're going to sell it to your daughter down the road, those are all prohibited transactions, and those are not good. Okay. Otherwise, though, you're good to go. Now, here's the problem in a self-directed IRA with this scenario, is that you do need to keep track of your expenses. And I know that sounds weird because we're in a tax-deferred or tax-free vehicle, but why do I say that? Well, you may be subject to UBIT if you finance a property inside of your IRA. So in this case, with 20% of your money involved and 80% of the financing, 80% of the quote unquote profits here are really going to come as a result of the financing. And so that amount can be taxed. Now, here's why I'm trying to think, have I had a client that has been taxed for UBIT with a finance property in their IRA? I can't think of one. And the reason for that is that we take our rental income, 20,000 or whatever, we back off our taxes, our insurance, all of these ordinary and necessary expenses, including our mortgage interest. Okay, we're paying interest, or we're not, but the IRA is, and the depreciation. And when you take the depreciation off, a lot of times that comes out to a tax loss. Even though you may have been cash flowing positive, you've got a tax loss that's not going to trigger UBIT. And so you can do this transaction, just be aware that you could have UBIT on the transaction. So that's the questions that Clay sent over, but now I see Clay's face, so hopefully the building is in good shape.
Apparently it was not actually a fire. Thank you for taking over the presentation in my absence. And I do see that we're kind of at our end time, or a little beyond that. So I think what we're going to do is go ahead and wrap up the presentation for today. There are some questions that didn't get answered, but we will answer them. So I'll go back and I'll make sure that I shoot them over to you, Scott, so that I can get some answers for folks. So for those of you who did enter questions that didn't get addressed here on the broadcast, we will handle those. And with that, I think I'm going to just go ahead and wrap it up and say, hey, Scott, thanks so much for bringing your expertise, and thanks everybody for tuning in. And sorry about the fire alarm. I didn't have any, that was unexpected. So any last thoughts from you, Scott?
No, other than just thank you, Clay, very much for having me. And I just encourage everybody that before you do any investment, any deal at all, consider the tax consequences of, what happens when you sell this or you cash out and investment does what you're hoping to do. What are your tax consequences? And before you make that investment, consider, should I do this in a taxable account, or is this something that I should do with Clay in a self-directed account? And once you do the deal, usually it's too late to undo it.
Got it. Yeah. All right. Thank you, everybody, for spending some time with us today. I hope this was helpful for you. And like I say, please feel free to reach out to Scott on it via his website, and to me via phone or email. And happy to be a resource for you in the long run. And thanks a lot for spending some time with us. We'll see you on the next one.
Thank you.